Good afternoon, everyone. Hope you're doing well. It's probably time for an update on the bond market, what's happening with interest rates on government debt. The charts themselves aren't too exciting. It's more of a bigger picture story. Obviously, a lot of carnage with the tariffs, with the US dollar falling. And I'll just get this title image out of the way and we can look at our first chart, which is the US dollar index. And I'm just trying something a little bit new today, different color theme for the charts and a different location behind me. Since it's a Sunday afternoon, it'd be nice to be outside. So let's take a look at our first chart, which is the US dollar. And the US dollar since the peak in January, just before Trump took the reins. Now, that might not seem like a lot, of 9.6% drop, but that is a very significant drop for for the major currency, the US dollar. And of course, there's this theory out there that, well, let's look at the chart first, and we can see that there was, we've looked at this in the past. I've talked about, back in the day that, or not back in the day, sorry, 6 months ago or so, that was a buy signal for the US dollar. But and then the topping signal, of course, you had the what you call the rising wedge pattern. You had the negative divergence on momentum indicators. And, well, I'm going to have to change the colors on charts so that we don't get our blues, and guess that's not the best color for those indicators, but that's fine. We can still see on the chart here that the US dollar has broken that sort of key 100 level. And while if we go to a 5-year chart, we can see that this level, and I've shown this in previous charts, that when it gets down to around the 100 level, it's typically, US dollars oversold. But this time around, it seems like it wants to consolidate a little bit below that 100 level. And that's not a good sign, because one of the theories out there was that, okay, I'm sure some of you have heard it, that Trump and his people, they need to bring down interest rates on government debt. And one of the ways they were going to do this was to let the stock market fall. We've seen the stock market fall significantly, or facilitate some kind of mini stock market crash and a fall in the US dollar, because up until Trump took the reins, the dynamic was the US dollar would go down and bond prices would go up, which means interest rates would go down, and vice versa. But that dynamic seems to be breaking, and that's a big problem for the US. And of course, Trump, he wants lower rates. He said, Trump renews calls for interest rate cuts, says Powell. If he understood what he was doing, he would cut rates. Well, he does understand what he's doing, because the Trump administration is about to, or has begun the process of adding tariffs on to, well, a tariff is a tax. It's a sales tax, effectively. So let me just close my, let's get rid of that. So the Federal Reserve Chairman has said that obviously they need to be concerned about inflation, because tariffs are going to increase the price of many products that Americans want to buy, and Trump wants lower interest rates because. Let's have a look at the spending first. So you could say it's early days, but have a look at the cumulative spending for 2025. All this talk about DOGE is going to cut all this spending. They're going to cut $2 trillion. No, they're not. The spending and debt accumulation will continue under Trump. DOGE will have minimal effect. It would be a rounding error at best. And you can see for the first 4.5 months, US government spending approaching 2,500 billion US dollars, which is almost 4,000 billion Australian dollars in just the first 4.5 months. And of course, it exceeds Biden's spending. So the Trump administration, it's kind of hard to tell on that chart, but maybe they've spent $100 billion more than Biden spent in 2024 by this time, by mid-April. So it's not going well. And of course, here's the inflation rate, and the Federal Reserve's target is 2%. This goes back to 2021. We saw the massive spike in inflation up to 9.1%. So that's way, way above the Federal Reserve's 2% target. So why should they be cutting interest rates when inflation is still, by their own doctored inflation measure, at 2.4%? Now, there are other measures that show inflation higher, but if we just look at the headline inflation rate, 2.4%, their target is a maximum of 2% inflation. So they shouldn't be cutting interest rates at all. But of course, Trump needs lower interest rates because, according to the Federal Reserve data, the current expenditures on, so how much the US government is spending to pay interest on its debt. We'll have a look at what it's done since the pandemic. Of course, massive debt accumulation to, quote, save us from the virus, because viruses hate low interest rates and massive government debt. That's how you defeat a virus, is you just run up trillions of dollars of debt and pay. Now the US government, according to the Federal Reserve, not some conspiracy website, the US federal government is spending in US dollar terms $1,124 billion per year to pay interest on its debt. And we know that this year the US government needs to reborrow about $9 trillion. $9 trillion is coming due. And the spending in the debt is almost at 37 trillion. By the time you watch this video, it'll probably be at 43 trillion. So they are accumulating massive debt, and none of this sort of stuff seems to be working for them at the moment. So let's come across to some of the key interest rates. The 10-year, I've drawn some lines here already. This is a daily chart, and this is very concerning because the Federal Reserve has been cutting interest rates, and as they've been cutting interest rates, it's bouncing around a bit. But as the central bank has cut interest rates, which is the short-term 24-hour rate, interest rates on 10, 20, and 30-year government debt have gone up. They've gone in the opposite direction. So that is a major concern for for the US and for the world in general. But what I don't like here, and why I might be a little bit cautious buying, um, I've been advising my clients to, because of the stock market decline, to reduce our allocation to bonds. So to sell some of their bonds, which were relatively flat during the crash, depending on which fund we sold, and going into stock funds that were down 15, 20% or so in the crash. So not to say that we made lots of money owning bonds, but at least we didn't lose money being overly invested in, too heavily weighted to stocks. We had a very low weighting to stocks a few months ago when stocks were at all-time highs. So we're shifting out of bonds back into stocks. But what I don't like is the interest rate on the key US 10-year. You can see this falling wedge pattern. You see it made a low there, and you can see some positive divergence forming on the momentum indicators. So the momentum indicators trending up. I might use the highlighter, that's easy to see. As the price was making lower lows, MACD and RSI making higher lows trending up, and now we've seen a breakout from this falling wedge. Notice you get the break and you get the return to the scene of the crime to test, and that tells me it's probably going to at least trend sideways or go higher. So this is a big problem. Now, I do expect at some point there's going to have to be, well, not have to be, but from the perspective of the central banks of the quote power structure, that they're going to have to intervene to bring these rates down. The market is not playing ball at the moment, so this is not good, especially when you've got $9 trillion of debt that you need to reborrow this year, which is the situation the U.S. government's in. Their interest payments are skyrocketing, and then the interest rate on longer term debt is going up. So this is a big problem, and it's somewhat of I won't say it's just a problem for America, but we're seeing other key rates. Like, let's take a look at the world's second largest economy, China. This is their 10-year rate, and this is a daily chart. But have a look at a 5-year weekly chart. Look at what China's debt has been doing. The interest rate on their debt has been going down. It's down. The interest rates dropped 52% from the peak in December 2020. Versus a 5-year chart of the US debt. Let's just flip back. Look at what the US debt interest rates are doing since 2020, going up. They're massively up. So China is seeing their interest costs on their debt come down in terms of the 10-year bond yield, and we'll see that on the 30-year yield as well, I would imagine, in China. You can see I'd already drawn some charts. Back in November 2020, they were paying 4%. Now they're only paying 1.86% to borrow money for 30 years. Let's flick to the US chart. US chart doing the opposite. Back in 2020, when China was paying 4%, America was paying 1.45%. Now they're paying 4.8% to borrow money for 30 years in terms of new bonds being issued. So obviously they have some bonds that they issued years ago at lower rates, but some of this debt is maturing and the money needs to be reborrowed. And if they're going to reborrow for 30 years, they're going to pay 4.86%. That is that's a big problem for them. In fact, if you crunch the numbers, and you might not be able to see my calculator, but if we look at the national debt, if we take the Federal Reserve's figure that the US government is spending, let's call it $1.1 trillion to pay interest on debt, and we divide that by 37 trillion in debt, we see the US government is paying an average percentage of 2.9, maybe 3%. On their debt, because a lot of that money was borrowed years ago. So they're paying a lower rate, but now they need to reborrow because governments go into perpetual debt. The US government doesn't pay off any debt; it just borrows more money. So they're gonna be paying higher rates. There is no interest rate on US government bonds that is at the current rate that they're paying, of the average rate of about 2.9%. The cheapest they can borrow money for is for 2 or 3 years at 3.8%. That's a massive jump. And of course, if they want to borrow money for 10, 20, 30 years, it's going to be much higher than that. So this is a big problem. We're looking at 5-year charts here. Now, I still do think that we've seen a major top in yields in interest rates back in 2022, 2023, when we saw that massive negative divergence as sorry, I meant to click that highlighted tool, as the interest rate was making a higher high, or the price, the momentum indicators were negatively diverging. You see that they're starting to flatten out. You can see we're at sort of a top here. So, and with central banks continuing to cut rates, continuing to signal that they're cutting rates, they will eventually, I think, drag these yields down and, of course, push bond prices up. But this should be very concerning, especially to the people who thought Trump was going to make some kind of difference. I don't know why anyone believes that a politician, that if you vote for blue team or red team, that it's going to make a difference. I don't think it does. And if Trump's plan was to crash the stock market and crash the dollar to try and push down interest rates, well, it's not working. And maybe he's got to crash the stock market more. I don't know. Well, if he wants to, I don't necessarily think they're that smart or that much in control. But if we let's come across to Australia now, and if we look at the 10-year yield in Australian government bonds, you can see it's not breaking out. We saw US bonds were breaking out and coming back to test. We're not seeing that on interest rates on Australian government bonds. And of course, the RBA, they've got the real estate hyper bubble to prop up. I don't know why they're cutting interest rates so aggressively. And if we look at the RBA cash rate futures, this is I can explain it in more technical terms, but this is basically where the market thinks the RBA. So the dotted blue line is where the RBA currently has interest rates at 4.1%. And this represents each month going out to September 2026. And this is where the market thinks interest rates will be each month. So the market is pricing that the RBA by November will be at 2.96%. Obviously, they won't set rates at 2.96%. There's just the market's trying to figure out how many cuts they're going to do. And, I guess some market participants think 3 cuts, some think 5, some might think 1. And this is I guess, an average of how many rate cuts the market thinks. But if the RBA is at 4.1 and the market's saying they're going to get to, 2.96, that means we're getting 4 to 5 interest rate cuts this year, at least 4. 4 by October. Again, why are they? Do any of you watching this video think the inflation problem's solved? Now, I know this is a little off topic, but in Australia, the average household, at least like the whole concept of government, is that they're supposed to be taking care of, the government's not there to take care of rich people. It's there to take care of working class people or poorer people. That's supposed to be the function of government. For most working class families or poorer families, their largest household expense is either the rent or the mortgage. I mean, in capital cities, people are spending 50 or 60% of their income on rent or on their mortgage payment. A little bit lower in regional areas, but I'm sure many of you can appreciate that's the largest expense that a household has, maybe aside from taxes, depending on, although if you're on a low income, you're probably not paying that much tax. So rents are at all-time record highs and skyrocketing. Real estate prices at all-time record highs. Mortgage debt or mortgage payments at all-time record highs. How is the RBA cutting rates? You might say, well, they need to cut rates to bring mortgage payments down. What about, only a third of the country has a mortgage, and some of those people would be higher income brackets who have bought a fancier house, and they borrowed a lot of money to buy that $2 or $3 million house, and they've got a big mortgage. A lot of poorer people rent. How do lower interest rates help them? That doesn't help their rent payment. So if rents are at all-time record highs, why is the RBA cutting interest rate? I mean, you know why. They've got to prop up the bubble. We're already in a recession per capita. So this is, and the Australian market, you can see the 2-year yield on 2-year Australian government bonds is collapsing, and that's the market pricing in that the RBA is going to be aggressively cutting. So our rates America's shorter term rates are dropping too, but you can see this is quite a bearish breakdown, which means interest rates falling. You could almost say that was a falling wedge. It's more of a kind of a triangle pattern, but I mean, it's angled down, so it's a falling wedge. You'd normally expect a falling wedge to break to the upside, and this one's broken to the downside. So that shows the market is just pricing in the RBA is going to be very aggressively cutting rates. And of course, the interest rate on the 30-year Australian government bond, looks like I've drawn some previous lines there. You can see it was in a rising wedge pattern, negative divergence, so it was a sell, and it's breaking down. So it was in this uptrend, meaning that interest rates were trending up, and you can see it's breaking down, and to end the week, last trading week, you can see it's breaking down from that uptrend and probably coming back to test this level. So while we're seeing breakouts on US debt, let's have a look at the 30-year US debt. You can see 30-year interest rates for the US, and theirs are falling sort of, well, not a wedge, but a falling channel. And notice theirs are breaking out and looking like they want to trend higher, whereas Aussie yields, Aussie interest rates are breaking down. So this is a bit of a problem for the US. I mean, the US is in a lot of trouble, and it's going to flow onto the rest of the world. Now, one more thing that we should quickly so again, so we're seeing these yields not coming down, even though central banks are cutting rates, like the Bank of Canada. Uh, what's that? 11 months ago was at 5%. They're now 2.75%. So they've cut rates 1, 2, 3, 4, 5, 6, 7 times. They've already cut interest rates. Again, is the inflation problem solved? The Federal Reserve's cut interest rates since, let's have a look, since August 31st. So they cut in September. They did a half a point cut. So they've gone from 5% to 4.5%. So the US has cut interest rates by 1% starting on the 18th of September. And if we go to the key US rate, which is the 10-year, it doesn't have to be necessarily, but that's what the market accepts as the 10-year. So if we go 18th of September, when they enacted that interest rate cut, and we have a look at the chart. So 18th of September, it was at 3.65%. It's now at 4.3%. So, and prior to that, it was up even higher. But as the Federal Reserve has cut interest rates on the short term end and on the short end by 1%, interest rates on longer term government debt have gone in the complete opposite direction, up 0.7%. And at one point, they were up 1%. This is very unusual, and it should be very, very concerning. Big problems brewing there, and probably too much to unpack in this video. But if we go to, there's one thing we haven't talked about for a while, and that's the yield curve inversions. And I don't know that I have time to explain it all, but if you can just roll with me on this chart. I have talked about it in previous videos, and if you'd like to understand it better, please do reach out or just type into Google or to your ChatGPT, what does yield curve inversion mean? In short, it just means that the interest rate on, so normally you'd have a positive yield curve. So if you're lending money to someone for 1 month or 2 months, it'd be a lower interest rate than 30 years. Obviously, if you're lending money to someone for a longer period of time, including a government, there's obviously the time risk. You don't have your money for 30 years, and there's the inflation risk, the risk that, I mean, think of all the things that can happen in 30 years as opposed to 2 or 3 months. So normally you'd have an interest rate, for 1 month at 4%, and then for a year it might be 4.5%. For 10 years it might be 5%. For 30 years it might be 5.5%. When the market starts setting longer term interest rates below the short term rate, so below the rate that the Federal Reserve or RBA would set, that's generally a sign that there's big problems, that there's a recession coming, because why would you loan the US government money for 30 years at 3% when you can put it in cash and get 4%? You'd do that if you either expected interest rates were coming down, so you wanted to lock in that 3% for 30-year rate before rates come down. You're worried about recession, market crash, bank failures, that sort of thing. So this graph is from the Federal Reserve, again, not a conspiracy website, and it shows the yield curve inversions, and the gray areas are recessions. So if we look at what happened when the yield curve, the Federal Reserve only takes us back to 1982, but there was a yield curve inversion that predicted a recession. You can see in 1989, the yield curve went below the zero line, meaning that the interest rate on a 10-year US government bond was lower than what it was on a 3-month government bond, so a very short-term interest rate. And then, of course, gray area, they had a recession. What happened in 2000? Again, the yield curve inverted, and it predicted a recession. Had the dot-com bubble burst, the NASDAQ crashed, US tech stocks crashed 80%. About the time this happened, I don't know the exact time it started, but we could look at a chart. And then, of course, the recession. And then just before the global financial crisis in 2007, the yield curve was again inverting. And we know what happened. See how when the yield curve, when this comes down, it predicts a recession. Of course, we had the global financial crisis in 2008. Now, it happened again in mid-2019, just before the pandemic hit. There were massive problems in the financial markets prior to the pandemic, and I think the pandemic provided a good opportunity, or good for governments to slash interest rates, print lots of money, run up a lot of debt to try and push off the global recession, depression for another 4 or 5 years with massive money printing and debt accumulation. So again, the yield curve knew that there was a problem coming. There was a problem. Look at where it went in 2023. Look at the depth of the inversion compared to these other crises. All right, so that's where it was in 2023. Look at what's happening now. It's just starting to notice how you don't have the recession when the yield curve inverts. You have the recession 6 to 12 months, maybe a little bit longer after it goes back into the positive. Once it starts trending back up, you have a recession. Once it starts trending back up, recession, trending back up, recession, trending back up, pandemic, recession, and wow, trending back up. So big, big problems. And if we go to GDP now, hopefully I've got it here somewhere. Uh, this is the Federal Reserve, and sorry, I should have preloaded this before the video. And of course, it's going to run very slowly because I'm trying to load it. Well, this is the Federal Reserve forecasting GDP, and their estimate is that for the first quarter, and keep in mind the first quarter's already ended, so they probably have a lot of the data. They're estimating about negative 2.1% growth, so massive decline. As soon as look at what happened, as soon as they were forecasting positive growth of 2% as late as mid-February, and then of course Trump comes out with these tariffs and bam, smashes growth estimate. So this is a big problem, and so it looks like right now, and things could change. It looks like right now the US, America is going into a recession, US dollar is falling, interest rates are going up, DOGE is not saving any money, they're actually spending more. I know it takes time to work this through, but so far they're spending more money this year than what Biden spent for the same time period last year. So this is all turning into a bit of a disaster. This is not a stock market video, I'm just focusing on the bond and debt markets today. So not too many exciting things to look at on the charts, but just putting together some of these bigger picture themes, we can see that problems are brewing and that we've very likely already started. You can see from and central banks aren't, I don't like central banks, but they're not stupid. They know what they're doing. I mean, they know I don't agree with what they're doing, but from their worldview perspective, they're doing what they quote know what they're doing. They know that we're entering we're probably already in a global recession or a depression. Why do you think why do you think the European Central Bank is slashing interest rates from 4.5%? They've cut them 7 times now. They're down to 2.4%. Is the inflation problem solved in Europe? I mean, I don't think it is. I mean, are Europeans happy with their cost of living, that everything's fine, we can slash rates now? They're slashing rates because we're probably already in a global recession, a global depression. Governments are going bankrupt. They've accumulated too much debt. They can't afford interest costs on their debt. Central banks are trying to drag down the interest rates. They're starting with short-term rates. I know some of the gurus are telling you that, this is going to spike, and, even some of my favorite gurus like Peter Schiff, or the market sniper Francis Hunt are saying that interest rates on long-term debt are going to spike, spike, spike. I disagree with that thesis because anytime that central banks want, they can relaunch their QE money printing programs, as some people call them, where they come into the market and they buy bonds and they push. The reason that they come into the market to buy bonds is because if they overpay for bonds, they push down interest rates. So anytime they decide, they can push down these rates. And of course, Trump he can't fire Jerome Powell, but best believe he's going to be getting rid of, and if you read through some of these articles, they're looking at ways that they can get rid of Powell. He's gone in May 2026, so he's only there for another year. And keep in mind, 6 months out from that, the market will probably start pricing in who the next person is going to be and what they're going to do to the bond market. So I guarantee you Trump is he's probably not going to stick with Powell, and he's going to pick someone who's on Team Trump and who's going to play ball and because look, Trump wants the rates cut. He's renewed calls for it. He keeps asking for lower rates, and lower rates means bond prices going up and interest rates on US government debt coming down. That's what now he's not getting it now, but that's what they want. And at some point, that's what they'll get. And they, in my opinion, are going to kick off or are already in the process of kicking off the next massive wave of inflation, global wave of inflation. And I expect it to be far worse than what we experienced through 2021, 2022. And that's what, now I know I said this is one video, but that's what the price of gold is telling you. That's why the price of gold is at all-time or very close to the all-time record high and trending up during this stock market panic. So as stocks have been going down, gold has been trending up and sort of accelerating and breaking out from those divergence signals. I mean, you could argue that the price is making a higher high, momentum indicators making a lower high, and it just busted right through that. So anyway, might leave it there. That's probably long enough. Thank you so much for taking the time to listen. Reach out if you have any questions. and be back with another update soon. Cheers.